things, let's welcome in Jenny Horn, co-host of Next Gen and markets correspondent here on the Schwab Network, to take a closer look at some of the early earnings that we have. We've got McDonald's to chew on, pardon the pun. Jenny, take us through some of the numbers.
Yeah, so actually looking a bit higher here now in real time here, Diane, which you described it perfectly. It was a mixed report from McDonald's. And I think that has so far been the landscape we've seen from so many of these companies that are either consumer facing or more discretionary, or in the very difficult fast food space. Because right now we know that McDonald's does not really have the same pricing flexibility and margin flexibility to work with in a still inflationary environment, especially with the threat now of tariffs and the way that could impact the cost of food. So overall, same-store sales were actually boosted, even though we saw the average customer dip. We saw fourth quarter earnings of on an adjusted basis, $2.83 a share, missing the estimate. On the positive side, though, those same-store sales overall rose about 0.4%, better than the expected drop significantly, which was calling for about 1.1% in decline. U.S. comparable store sales fell about 1.4%, again reflecting the drop in the size of the average consumer check. They also did see this partially offset by some pretty positive then comparable guest counts. Revenue at the company did remain flat on a year-over-year basis at just shy of $6.4 billion, but did also miss the analyst mark. So as far as expectations were concerned, bad. I mean, they missed on top and bottom line, but I think that you could fairly say there was things that were so much well beyond what the street had been expecting. Like positive comps has not been a consistent trend in the restaurant space we've seen this year. So that was a win, and perhaps why we've seen some of these disappointing earnings now being offset by some favorable price activity this morning, because there's things definitely to like about this report, that they're obviously trying to right-size their business here.
Yeah, it's interesting to see this one. I was expecting it to be under pressure in the pre-market, but it looks like they're shaking off that miss on revenue. And it looks like they're more focused, to your point, on global comps. And I wonder if some of this is, not just kind of the landscape that we've seen about same-store sales recently, but also some of this there was a unique challenge in the most recent quarter, right, Jenny?
There were. So there was very much specific headwinds that McDonald's has been facing. Like, for example, they had a E-Coli outbreak that was basically a type of outbreak that was contained to certain states, but they had to basically discontinue one of their menu items for quite some time. Well, they fixed that issue. They also have had some overseas issues with various basically PR nightmares, but also business mishandlings, which I would say is not good from a brand perspective, especially when everyone knows and loves McDonald's for the fact that they're consistent. And both these issues showed inconsistencies, and the consumers didn't like that. So we saw then really this I'd say more strained, heavily discounting company that is already being dealt with pricing pressures that is also facing now a public perception image problem, basically. And so that didn't help. So right now we're trying to get back more of these customers. Again, with discounts, I have not seen this in real time play out, but they did say that for that reason, they're trying to gain back the consumer that was lost during the quarter.
All right. Yeah. McDonald's right now, again, up 1.5% in reaction to the latest batch of earnings. Mixed bag, but Street likes the good more than the bad. Jenny Horn, thanks a ton for the deep dive on the latest quarterly numbers from Mickey D's.